Imagine your portfolio generating a passive income stream that can cover your living expenses indefinitely. Now you no longer have to punch the clock to earn a paycheck or worry about the fluctuating value of your portfolio. Instead, you can rely on dividends, fixed amounts paid each quarter. Dividends can be really attractive because they offer predictable cash flow on a regular basis. This means you can receive the same payment no matter what the stock price is in the market. The stability of dividend payments is especially helpful for those who expect a steady cash flow. In addition, dividend payments are less volatile than stock prices. This means that dividends provide stability during times of market fluctuations. Historical data shows that dividend payouts remain relatively stable with an average variance of plus or minus 10%. Thus, dividends are great for those seeking stable and predictable income. Companies that pay dividends tend to be more mature and prioritize stability. These companies have been in the market for a long time and maintain their payouts even during economic downturns. Sometimes they even increase their dividend payouts. In addition, dividends incentivize investors because they come with tax benefits. For example, if you receive a qualified dividend and your annual income is less than $47,000 per year, you don't have to pay tax on that income. However, it's worth keeping in mind that dividends aren't guaranteed. In tough times, companies may cut or suspend dividend payments. This is especially true during economic downturns when company profits are down. In addition, dividend payments do not compensate for declines in a company's value, so it is important to consider not only the yield, but also changes in the share price. Disadvantages of dividend investing include taxation. Unlike capital gains, which are only taxed when shares are sold, dividends are taxed when they are received. Depending on the tax category, the tax rate may be 20% or more. In addition, dividends are taxed twice, first at the corporate level as income, and then when they are paid out to investors. For some investors, this may mean that dividends become less valuable. This can be especially true if an investor is in need of cash, as they can then simply sell the shares. However, despite these drawbacks, dividend investing can still be a powerful tool for those looking to replace their income. It is important to weigh the pros and cons and consider your financial goals and circumstances before deciding whether dividend investing is the right strategy for you. To determine how much you need to invest to live entirely off dividends, you should consider your personal expenses and lifestyle. The average retiree in the U.S. spends about $50,000 per year. Let this be a base amount to consider dividend investing. It is important to look not only at the highest yield, but also at the consistency of dividend payments. Companies that consistently increase their dividends are known as dividend aristocrats, and they show growth and sustainability. There are 65 such companies in the S&P 500 that have been consistently increasing dividends for more than 25 years. They typically outperform the market during recessions. These companies' yields range from 0.3% to 5.3%, with the bulk in the 2% and 3% range. To replace a $50,000 income with a 3% yield, you would need to invest approximately $1,670,000. This can be achieved by investing $5,000 per year for 40 years and reinvesting the dividends. If you are looking for a faster approach, you can consider alternative methods such as covered call ETFs. However, this approach is limited in growth potential and may result in losing some of your initial capital. In general, it is important to keep in mind that living entirely off dividends requires determining your desired annual income and being aware of potential risks. Participation in this approach depends on the investments selected, their yield and market performance. Investing exclusively in covered call ETFs may not be the best long-term strategy, as it may result in limited performance compared to the overall market. A more diversified approach, although requiring a higher initial investment, is likely to be smarter over the long term. In summary, dividend investing can be an attractive choice for those looking for stable cash flow and predictability. However, it pays to be mindful of the potential risks and consider all aspects of dividend stock investing. It is important to note that this is a general approach and individual results can vary depending on the investments chosen, their yields, and the overall performance of the market. Also keep in mind that investing always involves risk and past performance is no guarantee of future returns. If this text was helpful, please give it a like and subscribe to future content on personal finance and investing.